Every business wants to know one thing: how much money it's really making. In this lesson, we'll discover how profits are calculated, why they matter, and how income statements help businesses make smart decisions. By the end, you'll be ready to explain every part of an income statement and boost your business studies score. Next, how profit is made. Profit is the goal of almost every business. It's what's left after paying for everything needed to run the company. The formula is simple: profit equals revenue minus total cost. A business can make more profit by increasing sales, raising prices carefully, or cutting unnecessary costs. Profit also helps a company grow, pay wages, and survive in the future. For example, if a bakery earns $5,000 and spends $3,000 on ingredients and wages, its profit is $2,000. That profit shows success and efficiency. Importance of profit in private sector. Profit keeps private businesses alive. It rewards their hard work, proves success, and funds future projects. Let's see how. First, reward for enterprise and risk-taking. When someone starts a business, they use their time, skills, and money, often without any guarantee of success. Profit is the reward for their efforts and courage. It also compensates for their risks, because if things go wrong, they might lose their savings. Imagine a young entrepreneur opening a smoothie shop with all their savings. At first, it's risky, but when their shop becomes popular, the profit rewards their hard work and bravery. Without profit, people would not take such chances, and new businesses would never exist. That's why profit encourages innovation and new opportunities. Next, indicator of success. Profit is like a scorecard for every business. When a company earns steady or growing profit, it proves that its ideas and strategies are working. For instance, a restaurant that doubles its profit this year must be serving food people love and managing its team well. Profit also attracts investors who trust successful companies, and it motivates employees who feel secure working there. Simply put, profit shows the business is healthy and on the right track. And the last one, source of finance. Part of the profit can be kept in the business instead of being paid to owners. This is called retained profit. It's one of the best ways to finance growth because it has no interest or repayment like a loan. Businesses use retained profits to buy machineries, upgrade offices, or open new branches. For example, a small bookshop can save its profits for a year and use them to open a second store. Retained profits help a business grow safely and remain independent. Difference between profit and cash. Many students mix up profit and cash, but they are very different. Profit shows how much a business earns after covering all costs, while cash shows how much money is actually available to spend. Think about a car and its fuel. Profit is like the car's speed, but cash is the fuel that keeps it moving. Even if the car is fast, it cannot run without enough fuel. In the same way, a business can be profitable but still fail if it doesn't have enough cash to pay suppliers, rent, or salaries. For example, a furniture shop sells $10,000 worth of tables on credit and shows profit on paper. But if customers don't pay soon, it may not have cash to buy new materials. That's why managers must always monitor both profit for success and cash for survival. Income statement and main features of an income statement. An income statement is a financial report that records a business revenues, costs, and profits over a certain period. Or, an income statement shows whether a business made a profit or loss during a specific time, usually a year. It's one of the most important tools for decision making. Now let's go step by step through its main features. First one, revenue. Revenue is the money a business earns from its sales before subtracting any costs. It shows how much customers spent on the company's products. The formula is simple: selling price multiplied by the number of items sold. For example, if a mobile shop sells 200 phones for $400 each, the revenue is $80,000. If it also sells 50 phone cases for $20 each, that's $1,000 more, so total revenue is $81,000. Higher revenue means better sales performance, a sign that customers like your product. Cost of goods sold. Cost of goods sold shows how much the business spent to make or buy the items it sold. It includes costs like raw materials, factory wages, and delivery of the goods to the store. For example, a shoe factory spends $20 on leather, $5 on labor, and $2 on transport per pair. If it sells 1,000 pairs, the total cost of goods sold is $27,000. Office salaries and advertising are not included because they are not part of production. The lower cost of goods sold, the higher the profit margin. Next, gross profit. Gross profit shows how much money the business keeps after paying for the direct costs of making goods. Direct costs mean things like materials and labor used to produce the products. For example, if a factory earns $50,000 in revenue and its cost of goods sold is $25,000, the gross profit is $25,000. If gross profit drops, it could mean production costs have increased or the selling price has fallen. Businesses track gross profit to check their efficiency. Expenses, overheads, fixed costs. Expenses are the regular costs of keeping a business open. They include rent, salaries, insurance, and advertising, all needed even if no goods are produced. For example, a cafe pays $2,000 for rent and $500 for insurance every month. Even if sales drop, these bills must still be paid. Good management controls expenses to protect profit. That's why owners say, watch your costs before they eat your profits. Net profit. Net profit is the final amount a business earns after paying for everything: materials, salaries, bills, and taxes. It shows the real financial health of a company. If a business has gross profit of $25,000 and expenses of $10,000, the net profit is $15,000. This is the money owners can keep or reinvest to grow the business. If net profit is low, managers must check which costs are too high or why sales fell. And the last one, retained profit. Retained profit is like the company's own savings account. After paying taxes and dividends, the rest of the net profit stays in the business. For example, if a company makes $60,000 net profit, pays $10,000 tax, and gives $15,000 in dividends, it keeps $35,000 as retained profit. This money is used for future plans like buying equipment or developing new products. It helps the business grow stronger each year. Using income statements in decision making. Income statements can also be used to make important business decisions. By forecasting revenues, costs, and profits for different options, managers can decide which product or location will be more profitable for the business. So I made an example case study here. Let's imagine a business planning to launch one of two new drinks, Juice A Fresh Mix and Juice B Energy Boost. If we look at the table, Juice A sells 10,000 bottles at $5 each, giving total revenue of $50,000. Each bottle costs $2.2 to make, so the total cost of sales is $22,000. This means Juice A earns a gross profit of $28,000. After paying for rent, marketing, and salaries, which cost $10,000, the net profit is $18,000. Now let's look at Juice B. Juice B is a premium drink. It sells 8,000 bottles at $7.5 each, giving $60,000 revenue. Each bottle costs $3.5 to make, giving a cost of goods sold of $28,000. That leaves a gross profit of $32,000. After higher expenses of $13,000, Juice B's net profit is $18,000. Juice A sells more bottles, but Juice B earns slightly higher total profit because of its higher price per bottle. However, Juice B also involves higher production costs and risk. If fewer people buy it, profit could fall quickly. If I had to choose, I would still pick Juice B, Energy Boost, because it shows higher potential for growth and better margins in the long term, especially if marketed well. Now you have learned how businesses earn profit, manage costs, and use income statements to make decisions. Which energy drink will you choose? Juice A or Juice B, and why? Share your answer in the comments and check the links below for more business studies videos. Don't forget to subscribe and keep optimizing your score. Bye bye, see you next time.